So Louis, Bob and we started this from about 15 years ago, and we have a pretty healthy international component to our portfolio. But Bob's just ready to give up on those emerging markets. He says, "That's it. I just want to buy the Magnificent Seven. That's all that's going to work in the future." But I feel like you might have a different opinion on that.
It's definitely all that's worked in the recent past. uh, Now, whether indeed past performance is indicative of future returns is is the question at hand. So first, look, I'd point out that um, for most of my career, emerging markets was really a byword for China. It was a byword for China in one of two ways. First, China was like 40% of the emerging market index, number one, and number two, the the broader emerging market cycle was highly dependent on China. China did well, and the other emerging markets just sold stuff to China. Whether you were Brazil, whether you were Indonesia, basically you were selling your stuff to China. So when China did well, emerging markets did well, and vice versa. Um, at least for the past 15 years or so. Um, I think what's quite unique in this cycle is that if you think of the past 18 months, we've had China do very poorly, much worse than anybody, including very much myself, anticipated. And at the same time, we've had a massive Fed tightening cycle. Um, Now, that combination, you would have thought, if you knew for sure 18 months ago that this would have happened, you would have thought, emerging markets are going to get crushed. Every Fed tightening cycle in my career, you've had a major emerging market blow up, plus Argentina plus somebody else. Um, and
Always Argentina.
Always Argentina. As a good buddy of mine likes to say, you get an economic crisis every 10 years in Argentina, and they last for about a decade. Uh, and um, the But what's been amazing in this cycle is you've had the Fed tightening cycle. You've had China do very badly. Everybody is running around saying abandon ship, abandon ship. But if you look since the bottom of 2020, things like the Indian stock market and the Mexican stock market have actually done much better than the US stock market. Brazil, Indonesia, even Turkey, the basket case of all basket cases outside of Argentina, um, has done just as well as U.S. equities. And having just picked on Argentina, we have to highlight that if you take the Argentina ETF trading in the U.S., the ARJT, it's actually outperformed the S&P 500 since the bottom in 2020. Um,
Wow.
so I think the perception out there indeed on emerging markets is that it's terrible. Meanwhile, you look at the performance, emerging market bonds have absolutely crushed US treasuries, which again, highly unusual in a Fed tightening cycle. Um, and all the emerging market equity markets of the big countries are doing as well, if not better than the US. So I personally love this. I love this. You've got an undervalued asset class because most of these equity markets are cheap with very decent momentum, and the public perception is terrible.
Yeah.
It's like, "Oh, I don't want this anymore." And the reason people don't want it is they bought the EEM, which again is 40% China, and China's has a bunch of issues, which if you want to go into, we can go into. So basically, babies are being thrown out with bathwaters here. Um, and I'm like super happy to catch these babies as they're being thrown out.
So I agree with you, Louis. I've been watching India's doing really well, Brazil, Turkey,
Mexico's
and
crushing
Mexico,
it.
amazing. I think that's a lot of that has to do with the perception of the onshoring and nearshoring that's going on, with manufacturing. But the Chinese market really isn't moving that well. It seems to be going down. So how does that jive with your picture?
I think onshoring is part of the story. It's definitely not the only story.
Hmm.
Um, there's of course different catalysts here and there. Um, Take Mexico as an example, something that's little talked about, but remittances from the U.S. into Mexico have tripled over the past 5 years. Why? Because all of a sudden in the U.S., people at the low end of the labor spectrum, the gardeners, the babysitters, etc., are getting paid twice as much as they were 5 years ago. I'm sure it's something that you've all experienced, right? It's all the low end workers in the U.S. now cost a lot more money, um, and I don't want to sound like I'm prejudiced or anything, but a lot of these low end jobs in the U.S. are done by Hispanic workers who then send a lot of money home. Um, so that's been a huge driver for low end consumption in Mexico. So each market has different drivers, but there is one common driver to all the emerging markets. And that is that in the past few years, you've seen two super important changes. The first important change is a direct consequence of the Russia-Ukraine war. When Russia invaded Ukraine, we in the Western world told Russia, okay, fine, then you can't use the US dollar, the euro, or the Swiss franc anymore. And we thought that as a result, the Russian economy would implode. Instead, Russia said, you know what, fine, I'll sell my commodities in Thai baht, in Brazilian reais, in renminbi, and Indian rupees. Now, if you're a country like India, you basically have unlimited demand for infrastructure spending. You need to build roads, airports, railways, power plants, you name it, they need it. Labor is not a constraint. They have as many workers as they want. The constraint for in India has always been getting access to dollars so that they could then turn around and buy the oil, the iron ore, the copper, etc., that they would need. So if now Russia comes knocking on India's door and says, hey, I'll do you a 5-year deal on oil at a 30% discount and you can pay me in rupees, India says, yes, please, every day of the
Sure.
week and twice on Sunday.
Sure.
Because now, all of a sudden, you've now removed India's only constraint to growth, which was access to dollars so they could buy commodities. Now, India gets as much commodities as they want. And so Modi can come out and say, I'm going to spend 150 billion US a year equivalent in infrastructure every year for the next 5 years, which, to put things in perspective, was roughly what China was doing from 2003 to 2008 when the Chinese economy really took off. This is what's happening in India. In the past year, India's opened 17 new airports, and they're building another 70 right now. So think about the demand for cement, the demand for steel, and from there the demand for airplanes, for radars, for this thing goes exponential. So that's your first massive change. The ability that all these countries now have of buying commodities in their own currency rather than dollars completely changes the equation for all these markets. And then there's a second massive important factor. The second massive important factor is that, actually, let me ask you guys a question. Um, 5 years ago, pre-COVID, China's trade surplus was 30 billion a month, right? Since then, like you said, there's been offshoring. We've tried to cut China out of the supply chains. We've done everything we could to freeze China out. So again, 5 years ago, China's trade surplus was 30 billion. What do you think it is today?
75.
Yeah, because you just read my piece.
Yeah. Why the link is here for our listeners. No. Chris had that number at his fingertip.
No, it is 75 billion. So China's trade surplus has basically gone 2.5x in the past 5 years, in spite of everything we've done to box China in. Now,
why has China's stock market done so poorly if their trade surplus is increasing, they've gone up market in what they're selling? What's the reason for the horrendous performance in the Chinese stock market?
because they're going through a massive real estate bust. They, 5 years ago, the Chinese government just said, look, we're in a massive real estate bubble. This can't go on. And in a sense, I think, the events we had in Hong Kong, I say we, because, I've spent the past 25 years in Hong Kong, and Gavekal is based there. The riots we started having in Hong Kong in 2014, and then again in 2019, were a wake-up call for the Chinese government. At the core of these riots was the reality that young people in Hong Kong couldn't afford real estate. And the Chinese government thought, okay, there's a huge real estate problem in Hong Kong, but it's a microcosm of what we could have here. We need to make real estate more affordable. And so every effort was made to basically bring real estate prices down. And given that most of the middle class had massively geared up to buy real estate in China or anywhere else, like, for that matter, but that effort to crush real estate has led to, obviously, the bankruptcy of pretty much every property developer, and just a crushing of animal spirits all around. Now, in my career, I've seen a lot of countries go through um, big real estate busts. You had Japan in 1991. You had Sweden in 92. You guys had your own in 2008,
Oh,
right? And
yeah.
you guys had we had a big one in Europe in 2011. Each time you get a big real estate bust, usually your banks go bust and you end up with a big rise in unemployment and a big economic crisis. China's had the real estate bust, but they haven't had the economic crisis. Instead, really the variable of adjustment has been yeah, the stock market. And you have a leadership in China that really doesn't really care what the stock market does, because unlike in the US, where I think 2/3 of American own stocks, in China it's a tiny minority of people who own stocks, and it's mostly rich people. So if stocks go down, who cares? Not only that, but most corporates don't fund themselves on the stock market. Most corporates fund themselves with bank loans. So the stock market settles where it settles. I don't think they really care. Um, Now, but going back to, so one of the reasons I think the Chinese economy did not implode, even though it's going through a big real estate bust, is very much because exports have been so good.
Right.
Which, when you think of it, is somewhat counterintuitive, right? You would have thought, given all the barriers we put on and the offshoring, etc. Now, the reason Chinese trade surplus has been so good is not that all of us decided to buy 3 times as many pairs of sneakers or 3 times as many plastic toys for our kids. The reason the Chinese trade surplus has gone 3x is that China's massively shifted its export mix and its export destinations. China, from nowhere 5 years ago, is now the biggest car exporter in the world, the biggest earth moving exporter. Uh, Railroads, power plants, turbines, you name it, China is now in that market. China right now is negotiating with Saudi Arabia to sell nuclear power plants to Saudi Arabia. I never thought I'd live to see the day where China is an energy exporter to Saudi Arabia. But there you go. And as a Frenchman myself, I look at this and I'm like, oh, this is French business. Like building nuclear plants, that's what we do. Um,
Right.
this is a real bummer. If China's coming in and taking that market from us, I mean, the Abu Dhabi the UAE opened a big nuclear plant. We built that. So, I would have thought we'll get the Saudi contracts as well, but it looks like we won't. So I highlight all this because what China's doing as it moves up the value chain in terms of its exports and it changes its export destinations, um, is that actually it changes also the currency in which the trade gets done. So when China goes to Indonesia and tells a coal miner there, or it goes to Chile and tells a copper miner, hey, instead of buying a Caterpillar, buy a Longhorn machinery, it's 2/3 of the price, um, and we can do the deal in local currency. It again removes a constraint of growth to all these countries, because now if I'm Chile, if I'm India, if I'm Indonesia, I can not only buy the commodities I need for my growth in local currency, but I can buy the machine tools, the machinery, the infrastructure, the power plants, you name it. I can buy that from China also in my local currency, or in renminbi with a loan from a Chinese bank. So I've just removed basically the constraints to growth in all these markets. And I think that's why, even though we've had a Fed tightening, emerging markets have continued to chug along.
Right.
They're simply no longer as dependent on the US dollar as they used to be, which is great news for emerging markets.
Louis, what's your outlook of the U.S. dollar? I know it's been weakening lately. Um, I mean, do you think there's a chance that like this they could form a new brick currency to replace the reserve currency, the dollar's reserve currency?
I think that I don't want to be rude, but I think that's the wrong way to look at it.
Okay.
Uh,
Okay. Yeah. Yeah.
the so
The ruder, the
I
better.
no, I think that's the wrong way to look at it. I think indeed most people look at the US dollar and think, but hold on, let's be serious. Nobody's going to change the US dollar for renminbi or for um, Indian rupees or for Indonesian rupiah or whatever. Um, let's stick with the Chilean copper miner, right? The way the Chilean copper miner works today is that he has a lot of, let's say, Antofagasta, you have a lot of working capital in dollars, because you need over the cycle to buy parts from Caterpillar, you need to buy machinery from Caterpillar, and you also know that there'll come a time in the cycle where JP Morgan and Citibank will decide, for whatever reason, we're not making loans to Chile. From past experience, that's going to happen. So you need to keep a lot of working capital in dollars, right? You need to do it, and your central bank also needs to keep a lot of reserves in dollars for that very same reason. The central bank knows there'll come some point in the cycle where the capital markets freeze for emerging markets, and so you better have a safety cushion. Now, in comes China, who says, "Hey, I'll sell you long her machinery for 2/3 of the cost," like I mentioned, um, and I'll give you a swap line on renminbi, so you can always pay for this, but you can actually, because Chile and China get together, you can actually pay me in Chilean peso. I'm fine owning Chilean peso assets. So now if I'm Antofagasta, I look at my working capital in dollars and I think, hold on, I don't need all this working capital in dollars. I can use that money, either give it back to shareholders, buy back shares, open a new mine. And so the US dollar ends up replaced with nothing. It's not
Mhm.
like I'm going to take that US dollars and put it in renminbi or in rupees or in a hypothetical BRICS currency. It's just I don't need as many dollars as I used to in my working capital or in my central bank. Take India. India's got $700 billion in US treasuries that it's painstakingly accumulated over 30 years to cushion basically against a oil price shock. That's really India's big concern is the oil price goes through the roof. I can't get access to dollars to pay for my oil.
Right.
And now in comes Russia and says, hey, I'll do you a 5-year deal at a discount in rupees. Then you look at that $700 billion and you think, well, I don't need that anymore. I don't know what the right number is, but it's no longer 700 billion. Maybe it's 400 billion. Maybe it's 300 billion. So again, what's important is to realize the dollar gets replaced with nothing. You just don't need as many dollars outside of the US as you used to in the past.
That's interesting. Never really thought about it that way. And I guess that's actually been happening since 2020, 2019.
No, I think it's really the real catalyst for this, to be honest, has really been the Russia-Ukraine war. Um,
Okay.
It's I think that's been the real catalyst for it on two fronts. First, of course, before the Russia-Ukraine war, all commodities were always priced in dollars and nothing else.
Mhm.
So the Russia-Ukraine war changes the pricing of commodity markets. So that's your first change. The second change, of course, is with the Russia-Ukraine war, we nationalized all the Russian assets. Right?
Yep.
We nationalized the Russian assets of the central bank, of the Russian treasury, but even of Russian oligarchs. And remember, we did this over the course of a weekend without any court orders, without any debates in Congress or debates in Parliament. Basically, prime ministers and presidents got together and said, you know what, let's just take all the Russian stuff. Um, Now, this was an electroshock for people in emerging markets because I think if we look at the Western world, the biggest comparative advantage we have in the US and France and Britain, etc., is the rule of law. It's property rights, right?
Yep.
It's the belief that you can be black, brown, white, yellow, Muslim, Jewish, Christian. It doesn't matter. You go in front of a court of law in New York City, in Paris, in London, you have the same fair shake as the next guy. And then we added a little asterisk to this. The little asterisk we added was except if you're Russian. If you're Russian, we can just take all your stuff. No questions asked, no court
Yeah.
orders, no. So now if you're Chinese, and by the way, we said except if you're Russian. And as we did this, we basically looked at China and said, and you're next. We're also coming for you because we don't like you either. We also think you're a bad actor. So you're next. So if you're Chinese, imagine you're a rich Chinese guy or a rich Arab or a rich Indonesian, you think, what do you mean except if you're Russian? I was buying this house in Vancouver or this house in New York on the premise that if things go bad in my own country, because I can't trust the government in my own country, at least I have a fallback here.
Yeah.
But actually, it turns out that I can trust your government even least than I can trust my own. Um, and so, you know,
That's a hell of a message. Yeah.
and so I think the real change was February 2022. That was the change in the global financial architecture, and we're slowly working our way through it.
So Louis, we're U.S. based, right? So every investor I've ever met, I've been investing people's money for 50 years. We're always,
And you still have all your hair?
I still have all my hair. Can you believe it?
An abundance,
Yeah.
an abundance of hair.
That's very impressive.
Yeah, I give gray hair. I don't get gray hair. That's what I say, right? But everybody has a domestic focus, right? You
Of
feel
course.
amazing. Man, if you're the wealthiest person in France, you don't want all your money in the U.S. market because it's risky, right? So, you know, having a global perspective, where valuations are today, how would you allocate your equity dollars around the world?
Well, I spend a lot. I love reading history. I love reading uh, shifts, etc. But if you look at the 1970s, the driving force of market, you start off with the Nifty 50s, and then it was U.S. oil stocks. And you got to the late 70s, and 6 of the top 10 companies in the world by market cap were U.S. oil companies. You get to the 1980s, and it was, the time where if you didn't learn Japanese, you'd never have another job. And by 1989, 45% of the world MSCI was Japan. 8 of the top 10 companies in the world were Japanese. 1990s was all about U.S. internet. 2000s was all about the emergence of China. And of course, the past 10 years has been about software eats the world. You mentioned the Magnificent Seven. And that was the theme. Now, if you look through these themes, it looks like every 10 years you go US, non-US, US, non-US, US, non-US. You also go value growth, value growth, value growth. And it seems to be these sort of 10-year rotations. And, right on cue, right now, people are going around saying international diversification is for the birds. Value investing is for the birds. And, you just have these one decision stocks. You just buy them and hold on to them. And this is what you see every cycle. So right now, as expected, everybody tells you international diversification is for the birds. Meanwhile, you're already seeing a number of large markets starting to outperform the US. I mentioned Mexico, I mentioned India, Brazil, but even some of the developed market ones, like Japan, is going through a bull market. Nobody cares. Nobody's talking about it, but Japan's going through a bull market. So, if you look back at 2023, I think you had a few very interesting bull markets. Of course, you had the bull market in the US, but the bull market in the US, we know, was a very concentrated bull market. It was a bull market that was around, like you mentioned, the Max 7. The rest of the market really didn't do that great. And one part that I find alarming is that in the US, the financials did very badly. Now, again, I don't want to be offensive, but if we start off with the premise that banks, insurance companies, financials in general are basically parasites on the economic beast. They feed off the underlying growth of the economy. If you have a healthy beast, you would expect financials to do well. So at Gavekal, we spend a lot of time looking at what banks are up to. Are bank balance sheets expanding? Are they making loans? Are bank shares expanding? In a bull market, you would expect banks to do well. It doesn't mean they outperform, but you would expect them to participate. I hate a bull market where I see banks go down 20%, which is basically where the US is. This is not a sign of, okay, we're in rude health, this is going to continue. I also don't like a bull market in which you're also losing money on bonds. For me, a proper bull market is what we call a triple merit scenario, a period of falling real interest rates, rising exchange rate. And it is that combination that allows for a re-rating of real estate, a re-rating of equities, and everything points in the same direction. The reality in the US today is you've got your Magnificent Seven pointing in one direction and everything else pointing in the other. Meanwhile, you go to Japan, super healthy banks, broad market, rising real estate. It's like it's all pointing in the same direction. So it's like, okay, this ticks all the boxes of a normal bull market. I'm comfortable playing there. Same story in India, same story in Mexico, same story in Brazil. So when you look at the bull markets of 2023, where did you have bull markets? Latin American debt and Latin American equities. Perfect. Let's play that one. Momentum, let's play with it. I get it. I think the geostrategic risk there is minimal. Let's do it. Japan, same story. No geostrategical risk minimum there, etc. Okay, play that. India, boom, same story. And the US is a standalone market where, yes, you have your bull market in Max 7, but it comes with a lot of red flags. So it's a little bit like, now, out of all of these markets, it also happens to be the one where the valuations are the most stretched, that is by far the most overowned, and where there's by far the highest retail participation. So it's like red flags. There's more red flags than on Bernie Sanders' yard on May Day. So I just don't feel that comfortable with it.
Yeah, I agree with you. I mean, it looks like a replay of 2000, where you get this democratization of the market where everybody's an expert and you can have a one-stop, index or one-stop stock, or in this case, seven. We've totally, and we agree with you totally in that scenario, in that viewpoint.
By the way, on this, have you ever seen the movie The Magnificent Seven?
Yes,
Yeah,
as a matter of fact.
You know that 4 of them die at the end, right?
Oh, that's good. I'm going to use
I'm
that.
stealing
That's
that.
good.
I'm definitely stealing that.
That's
Sure.
really good. So,
Yeah.
Louis, what kind of shape are the banks in like China? How are banks in China doing? With this real estate bubble bursting.
So I think the first thing we have to acknowledge is that banks in China are not your typical capitalistic enterprise. Uh,
True.
they're they're really arms of the government, for better or for worse. So for worse is your shareholder returns are low on the list of CEO priorities, if they even make the list.
Yeah.
Um, the For better, um, they don't have to recognize bad loans.
Hmm.
The big difference in China is, um, if you make a bad loan, etc., you sweep it under the rug and you hope to grow yourself out over time. uh, Bank loans are not really driven as much by again, economic returns, as much as they are by policy. The government tells the banks, okay, you guys lend or you guys don't lend. So we've gone from, so all this to say, if you look at the bank share prices, they basically flatlined for the past 2 years. They've actually outperformed U.S. banks amidst the big real estate bust in China.
Hmm.
They've done better than U.S. banks, um, and they offer high yield. Um, so um, I think basically Chinese banks is kind of dead money. I don't think they're going to collapse, but they, again, they're an arm of the government.
Right.
So now, what is happening in China is bank loans are picking up, again, under government impetus. Um, so you could say, okay, well, that's a positive, um, but you also know that their balance sheet is loaded up with bad debt. But that's why they all trade below book value, um, and and that bad debt will just have to be worked out over the coming years.
So, Louis, oil's been dropping, um, and we had that big spike, when the war started in Ukraine. When the Russians invaded. So, is that with the global economy, in your perspective, seems to be doing really well. I mean, the U.S. GDP was over 5% last quarter. Europe seems to be recovering nicely, and you think China has held up really well. Why? What's going on with oil, in your opinion?
I think myself, most people, etc., have been on came into the year thinking the supply of oil was tight. Um, and I
Right.
think the big surprise this year has been that, uh, if you go back to July 1st, the U.S. was producing 12.2 million barrels per day, according to EIA figures. Um, you fast forward 11 weeks to early October, and by then the U.S. was producing 13.2 million barrels per day.
Yeah, the
So
most ever.
The U.S. added, on official numbers, the U.S. added a million barrels per day, and it managed to do so with no increase in capital spending uh, on the oil patch and no increase in employment.
Just more efficiency.
Yeah, they're doing it with less rigs. Yeah.
And fewer rigs. It's like, oh my god, like the productivity gains here are just outstanding. So I think if you're an oil investor now, you would think, okay, great news for oil stocks, right? They get to produce more with less. uh, you wouldn't know that though, looking at the oil stocks. um, but so right now, the story, if you look at the official numbers, you're like, oh my god, they're producing so much, this is amazing. um, then from there you have to think, okay, if you've had this productivity gain in U.S. oil production, how long till you have this productivity gain in Canada, in Brazil, in Mexico, in Saudi Arabia, in Nigeria? Whatever methods are being used in the U.S. Now, how can we explain this sudden surge in productivity in the U.S.? I think there's three possible explanations. The first is, you'll remember that this summer you had a bunch of private equity activity. Exxon took over Pioneer,
Yep.
Chevron took over Hess. So I think if you're owning a small oil producer, you're probably thinking, okay, time to sweat the hell out of my assets. Uh, crank it up here and sell myself to whoever's got the pocketbook open, right? So that's one possibility. That every producer out there is in and then it raises the question, how long can you sweat the asset for? Sure, you can, maybe get a little short-term boost, but without employment, without capex, how long can that last? Option one. Um, Option two, you could say, no, no, no. It's the application of artificial intelligence, application of software, um, that we can now get so much more with less. And again, if that's the case, we can apply that to the rest of the world, and that's quite bearish oil price. Option three, you could say actually these EIA numbers are bullshit. Excuse my French. But these EIA numbers are basically made up, and that's been part of the feud between OPEC and EIA, where OPEC is basically saying, look, you guys are making this up. And um, my own my own perception is there's probably a little bit of the three. Uh, there's probably a little bit of the three. I think the next 3 months are key. We're going to have to see, whether that 13.2 million barrels per day in the U.S. is a spike, or whether it continues. Whether it's basically it's a new plateau or on the way to even higher. Um, I think if you see a rollover in that 13.2, oil prices will come back up really quickly.
Right. It just depends how much they can keep pushing it. And the slowdown China, is that part of the story as well? Because that's what you're hearing in the U.S. It's that China's still in a slowdown, demand there is weak, or is it less of that and more productivity gains, in your opinion?
I think I think the China story is a bit different. What's been fascinating to me in China is actually China for the past really since the start of COVID has been importing more than it needs. China's been building just as the
Mm.
U.S. has emptied out its strategic petroleum reserves. China's been building one of their own, and China's constantly imported probably probably about 1 million barrels per day more than it needs. Maybe not a million, maybe
Right.
700,000, something like that, more than it consumes.
So it's,
um,
it's more productivity gains right now than it is China slowing down per
I
se.
think so. I think China's
Yeah.
been, and China is still stocking up. And by the way, the more the prices fall, the more China buys. But it does mean structurally, when you think of it, that it also caps the oil price on the upside, right? Because basically China is in essence saying, look, below 80, we'll buy whatever you want to send us, and above 100, we stop buying. And if by the fact of stopping buying, then it's hard for the oil price to go above 100. Now, that's why I tended to think that the oil price would stay between 80 to 100, because below 80, China's a buyer in size, and above 100, it's no longer a buyer. And given that China is still the biggest marginal buyer in the world, um, you would think it could basically dictate the price. Um, so that's why I'm surprised it's below 80. Um, so you could say perhaps one explanation is that China's ability to keep on storing oil has now reached, like maybe, they can't store it anymore. Basically, if that's the case, though, you would think that probably the VLCC rates would be shooting up. That because
Yeah.
China could store it on VLCCs, but you're not really seeing that. So I don't know.
Well, one thing markets always do is surprise. I mean, remember we had that one print was -$30 a barrel
Yep.
not that long ago. Um,
And
as one,
China was in the market then, buying all it could.
Yeah. And we
Uh,
weren't. And we
yeah.
weren't.
Yeah.
It's frustrating.
yes.
Yeah. Yeah. But Trump's a smart businessman. All right. I digress.
Maybe they were distracted back then, I guess.
Yeah.
The China
um,
China had a little more runway. They
yeah.
knew what was coming.
Well, I guess that's a bigger question too. Is just, I mean, would you be a buyer of Chinese equities here? I mean, do you wait? Is the bottom not completely out yet, or is it time to start nibbling on the Chinese market, given the fact that that market just seems to be in a perpetual downturn from a U.S. perspective and U.S. dollars?
So I think there's many ways. Look, historically, there have always been many ways to play Chinese growth. Chinese equities have not always been the best way to play Chinese growth. People
Hmm.
who played the big China boom through the commodity markets or by buying LVMH and Hermes, often did better than buying Chinese equities. Now, today, I think a lot of commodity plays have been beaten up. Um, uh, you know, Copper is an obvious example. Nickel has been just taken to the back and shot. So is lithium. I mean, lithium's down 70% this year. Um, and we just mentioned energy. A lot of good quality energy companies are trading on single digit price to cash flows. Um, if China does so buying a lot of these names today you're playing both a potential China rebound, but also this sort of structural bullish outlook on emerging markets that we discussed. If either one of these things come true, you should make money on these names. While of course the Chinese equity names are probably more a play on just China doing rebounding, if that
Right.
makes sense.
Hmm.
So it's a more narrow play. Now, having said that, I think within the Chinese equity market, you have, of course, different pockets. I think everything linked to real estate and to financials in China still has big hurdles, and you're still in a pretty strong downward momentum. Everything linked to China's export industry, that's corrected a lot. Um, I actually think that's interesting. Names like BYD, which is I think is going to be the biggest automaker in the world. BYD is now selling electric cars to places like Australia for 11,000 US dollars a car.
Yeah.
It's gonna be very hard to compete with that, partly because
Yeah.
China controls the entire battery supply chain from the nickel upwards. So I
Well, it's
think,
funny you said that. Elon Musk said the other day that their only real competition, Tesla, they're not looking at other U.S. car makers. It's China. That's
yeah,
their
yeah,
biggest competition. He's not concerned about
no,
other U.S. manufacturers at all.
if I were in his shoes, yeah, that's
Yeah.
how I'd feel as well. I mean, you look at some of these Chinese autos, and here this was a real shock to me. I have to say, because I usually go to China every because I'm in Hong Kong, but I go into China at least every 3 months or so. But of course, during COVID, I didn't. That was the first time in my adult life that basically I was gone from China for 3 years, because you just couldn't go back in. Um, and when you came back in, all of a sudden there was such a jump in the quality of autos. Uh, you saw hundreds of brands that I'd never heard of before. Um, you'd walk through a Chinese shopping mall and you'd see cars that you're like, oh, this car looks great. I wonder what it is. I want it for myself, and be a brand you didn't know. Uh, yeah, it's the the auto landscape has changed so dramatically in 5 years. It's mind blowing, and I think people in America don't realize it because they don't see Chinese cars on their streets. Uh,
Never.
but if you
That's
go
exactly right.
if you go to Europe now, actually, and a lot of Americans do go to Europe, and you rent a car, there's like now a 30% chance you're going to be given a Chinese car.
Chris refuses to do that. He's a real patriot, so he would never run a Chinese car.
It doesn't even go to Europe.
What
But
are you
he's a
talking about? I got a brand new Great Wall Motors vehicle out in my garage.
the
he
uh,
says the Chevy Bolt's the only electric vehicle he'll ride in. But
the but so if you're going finishing on the China story, then the other big play, which is the way Americans have typically played it, is of course all your internet names, your Alibabas, your Baidus. That's typically the way Americans play it, and those names have been basically taken back and shot. You're basically
yeah,
buying Alibaba now at 7 times cash flow. Um,
crazy.
and on this, I think the perception is that these names are Chinese names, but increasingly they're emerging market names. Alibaba's got a really big business in Latin America. It's got a really big business in across Southeast Asia. So I think here, for the patient investor, uh, the look, you don't break a leg jumping out of the first floor window. When you're buying good quality growth companies that are growing at 15-20% a year at 7 times cash flow, I think
Yeah.
things usually turn out okay for you.
Okay, so outside of China, what do you perceive as the best emerging market opportunity right now with the long-term view, and not the yield to noon that Chris is looking for?
I think it's hard to knock Mexico today, to be
Mm.
honest. It takes every single box. It's not expensive. Real rates are falling. Um, it's geostrategically, it's very, very well placed. It's benefiting from the offshoring trend. It's got good demographics. Its currency has come up, but it's still like you got positive momentum on the currency, positive momentum on bonds, positive momentum on equities. Um, why fight the trend? It's to me that seems like the most obvious slam dunk.
Never really thought about that. All the money flowing back, from the U.S.
Yep.
and with our inflation rate, all those costs have gone up, and actually, the wage increases for the lower middle classes countries been been dramatic. So that's I love these conversations. You look at things very differently, than a lot of people looking at the same
You
business.
know what you could buy, and it's a great looking chart, is Walmart Mexico. It's a 45-degree angle. It looks, to be honest, it looks like the Bernie Madoff performance. Uh, it's it's just like it looks like a nice ski slope. Um, Walmart Mexico is, and for especially for American investors who are like, oh, I don't trust emerging market managements. I don't, they're going to lie to me. It's like, no, no, no. This is U.S. management of
Yeah.
a business that's easy to understand. Uh, do you think the low end consumer in Mexico makes more money? And the answer is yes. Uh, and this is how you play it.
Louis, one of the things you had mentioned in that great article you wrote is, kind of the gist of it is like, whatever barriers are put up, it's like the world finds a way to be productive. And one of the things you talked about is linking, making these links between countries, investing in infrastructure and creating those links. Can you talk a little bit more about that?
Yeah, absolutely. And thanks for your kind words on the article. Um, Look, and this article is really, to be honest, a reflection of my own personal experiences. So, I was born in France, and in the early 70s, um, and the big story as I was growing up was the integration of the European continent and the European Union, taking down the trade barriers, free movement of goods, free movement of people, and that went into hyperdrive once the Berlin Wall fell, and that was what drove really, 10 years of bull market in Europe. I moved to the US for college in the early 90s, and then the big story was NAFTA. And then again, big integration, big move, etc. And I moved to Hong Kong in 98, 97. And as China was getting ready to join the WTO, the big story became Chin America. Um, Now, today, sort of 20 years later, the story is the story we're told in the Western world is deglobalization, and we're going to therefore have higher inflation and lower productivity, etc. But I think that's taking a very Western centric view, because actually global trade is still expanding. But it's expanding because emerging market to emerging market trade is booming. Um, and for all the reasons I just highlighted, more trade from Russia to India, more trade from Russia to Brazil, more trade from Russia to Indonesia, but also more trade from China, selling machine tools, cars, all these things. Um, but all this trade that is occurring requires infrastructure. It requires ports, airports, railways, uh, canals, power plants. It needs all of that, and you are seeing it across the emerging markets. Hardly a day goes by without some new canal, some new port, some new free trade deal being announced, really across what I would call the Eurasian continent. um, or in our research, we've talked a lot about an axis that basically you draw a line that goes from Istanbul to Jakarta, um, and you go 500 miles on each side of this line. So you draw a big rectangle, and within that rectangle you have 3.6 billion people who live there. You have population growth of 1% and income growth of 5%, some of the highest income growth in the world. And that 3.6 billion people in the next 10 years will all be buying motorcycles, cars, refrigerators, microwave ovens, all this stuff you take for granted. They're not all going to be able to buy them, but a lot of them are going to be able to buy them. Why? Because incomes are progressing, and as incomes progress, people tend to buy the same things. So, in China, as people, you move from average income of 8,000 a year to 10,000 a year over the space of 3 years. China's consumption of cars moved from 2.5 million cars per year to 18 million cars per year.
Wow.
Uh,
Yeah. Incredible.
and that's when oil prices, went from $30 to $120 because the world wasn't ready for it. Well, remember, China was 1.2 billion people. This is 3.6 billion people. So my contention is people are dramatically underrepresented in commodities. The copper, the iron ore, the energy that you're going to need for all this. Or alternatively, you have to think that the productivity gains we're going to see in places like energy extraction or in energy consumption are going to be enormous.
Yeah.
But I think if you're not focusing on this, you're actually missing the bigger picture. It's like people who weren't focusing on the surge in China-U.S. trade and the outsourcing of everything to China in the early 2000s. If you missed that back then, you missed the story for the next decade. And so I think today, the Western world's focus on, oh, look at what we're doing in AI, look at what we're doing in computing, look at what we're doing in biotech. We're staring at our own belly buttons, and we're
Right.
missing the bigger macro picture out there. I really believe that.
Yeah. I think maybe you persuaded Bob that he needs to invest outside the Magnificent Seven, Louis. I think that's. I think you just closed the deal.
One step at a time. Walmart, Mexico. That's an easy step. Like,
Singing my tune now.
Hey, hope you're enjoying episode 143, Pain Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you saved over $1 million and you want a more hands-on approach, Bob, Chris, and I, with our collective 75 years of experience, will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full, holistic review. We literally look at everything. There's not a firm out there that will do this work up front. We'll build you your own personalized financial portal, give you a bird's eye view of your entire financial life, and hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security, how do you draw from your portfolio, how do you factor in inflation, we'll build you a dynamic income plan. We'll look at diversification. Market's been like a yo-yo the last 2 years. Has your portfolio been up and down? Or have you been sitting in cash? Paralysis by analysis, can't figure out what to do. We'll put together a full investment game plan tied to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life, and we'll look at fees and taxes. We'll do a deep dive of every investment you own on those annuities, insurance products, brokerage products, structured products. We'll show you where all the hidden costs are, show you how to reduce that cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you saved over $1 million for your financial independence, simply go to www.paincm.com/financial plan to see if you qualify for a free financial review. All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, the total market cap of the Magnificent Seven is now 3 times the size of every single stock in the Russell 2000 index combined, making just 7 stocks the equivalent of 6,000 small cap names. On average, 47 analysts follow the Magnificent Seven versus just 5 for a small cap name. 9% of smaller companies have no followers at all. Wow. Sounds like small caps are a buy.
Well, here, this might be shocking news to everybody, but artificial intelligence is going to benefit every one of those small cap companies. But, why would you want to invest in those when you can overpay for stocks at 100 times earnings?
This is definitely the anti-Magnificent Seven podcast if we've ever had one. All right, Chris, there are roughly 16 million American households that are worth 1 million or more, but that number includes primary residents. So the number with 1 million investable assets is much smaller, something like 5% of the population. If you have $1 million in investable assets, you are certainly not middle class or upper class, you're rich.
Well, it just goes to show you can sell that $1 million house and go live in a tent to become super rich.
It's all relative, though, that's for sure.
We're always for that outdoor plumbing, Chris.
Chris has got a nice outhouse. All right, Bob.
Only one in Center City.
Bob, since 1800, gold has returned just 0.32% a year after inflation versus 3.07% for the 10-year Treasury note and 6.83% for U.S. stocks. Interestingly, we are only 15% above the peak during the American Civil War in the 1860s when inflation was very high. So you can be a long-run inflationist but still be a bit underwhelmed by gold as an investment. 2,100 at the end of December, which is everyone's making a big deal about gold over $2,100, is still below the inflation-adjusted high of $3,333 reached in early 1980. That's crazy. So you still lost money in gold in inflation-adjusted terms since the early 80s.
Well, you know what I always say, gold is something that looks really nice around the neck, around the wrist of the person you love. It's never been a good investment. You can't eat it. You can't carry it around. Doesn't pay a dividend. You got to store it. If you do happen to get lucky and make a profit, you got to pay 28% on capital gains because it's collectible. It's not an asset. I don't know why anyone would invest in gold beyond me. But, these people that sell gold on TV are making a lot of money because those commercials are expensive, guys. Don't forget, somebody's got to pay for those commercials. And I think it's the gold investors, certainly not in their return.
You always say that investments are always sold and never bought.
This is true, Chris.
Let's not make fun of Chris's commemorative coin collection right behind him over there.
Those are patriotic coins, I'll have you know. Show a little patriotism. Thank God there's at least one good American-loving citizen on this podcast.
I think if you go to Morgan & Morgan, you can pay them with Morgan silver dollars, kind of like the same area, right? The same kind of
That's right.
process.
Well, another great episode. I hope you enjoyed episode 143, Pain Points of Wealth. If you like our podcast, maybe love our podcast, please give us that 5-star rating on iTunes. Leave a comment there. Let people know how great our podcast is. If it's on Spotify, you can subscribe. If you're watching this on YouTube right now, you can like this episode. You can subscribe to our channel. Click that notification bell to be updated every week of all our new content. Your support for our podcast gives us the ability to keep doing this podcast. As always, stay loose and keep an open mind.